European cash close as per now regular practice. Let's have a bit of a recap and a review of today's trading session, some of the major things that we've seen. And certainly what was set to be calendar-wise quite an important day, just given the inflation reading, the PPIs earlier, could have potentially acted as a bit of a catalyst for then another repeat day of decent price action like what we had from the Yellen testimony on Wednesday, but it's kind of failed to materialize to the same degree. So much into translating into the same scope of price movement, but certainly there has been a few things that have moved. I guess, first of all, there wasn't really a great deal coming out in the morning. You had a little bit of a positive sentiment read across from the Asia-Pac region, just given the fact that most of Asia was higher, taking the baton from the higher close on Wall Street yesterday following the dovishness from Janet Yellen. And then you had Chinese trade data as well, which exceeded expectations. That did help lift as well, probably a little bit of the sentiment. But not a great deal in European morning, so really it was centered around just awaiting that US data, and it was a bit of a damp squib. It didn't really cause too much market movement. This was the PPI number itself. The year-on-year came in at 2%. Which was 0.1 higher than expected, but the core readings were 0.1 lower than expected, so net kind of net neutralized each other out. And I guess from a point of view that the market was potentially expecting, just given the slight tweaking to be more dovish from the inflationary perspective from the testimony from Yellen yesterday, that potentially these numbers could have been soft, and really that didn't materialize. So we've not seen too much movement in the dollar. And so it's been a bit of a tough call in terms of the major pairs today. Looking at cable, it did see a bit of a push through highs that were seen yesterday and also back on the 11th, so earlier this week. We did have some comments obviously from Ian McCafferty, who's one of the outlying hawks on the Monetary Policy Committee, talking about the need to start basically cutting down on QE, and the complete opposing view of Ben Broadbent that we heard the day prior. So sterling had a little bit of a boost earlier on. We kind of found on the pullback a little support back at around that previous high that we saw on the Yellen fluctuation in currencies on Wednesday afternoon, and then we've kind of just gravitated towards settling on the R1 level. Looking at euro dollar as well, let's just pull that into shot. Did see a bit of a break lower earlier in the afternoon. That came on the break initially of the low that was seen again post the Yellen reaction around that 114.31.5, prompted a bit of a further extension on the run lower, but then got down to S1, bounced quite aggressively, and before settling at around that kind of same level of which the break came earlier in the day. So again, pretty tricky overall, not particularly clean in one direction or another. Again, the dollar index on a percentage change at the moment is pretty flat really. It's only up about 1/10. Looking at the equity market, a little bit of downside pressure seen shortly after the open on Wall Street. Technically the pivot working out pretty nicely in the Dow, when it originally ran lower. Again, not a great deal of news flow behind the move, and so I guess people just using that opportunity at a technical level to just buy back into some of the initial weakness and the selling pressure that was seen shortly following the open. Crude oil has certainly seen a decent move on the upside. You know, we've had these, you can see here, really three big periods of price movement. An initial move higher on the bullish API data, reversal then yesterday that we had where the numbers weren't any more bullish, and so kind of it had already factored in big drawdowns, and then the US output number was up. We reversed, declined somewhat over in Asia, only to then really lift as the US have come in. There's not really been a great deal of fundamental factors to base this on. And so hence I think now it's run up to that R1. It's just run out of a bit of steam, because I think this is more just people just continuing the trend that's been apparent from the morning rather than really anything based fundamentally. So R1 just proving to be a bit of a point of resistance. You've got that double top, kind of the high on the 6th and the 12th sitting just above as well at 46, 48. So some pretty decent levels of resistance potential on the upside, because despite the fact we're up 64 cents, I would say still the bias would be being more bearish than bullish oil at this point, especially on the move back higher with US output coming back online at year-to-date highs at this point. Okay, quick look ahead to tomorrow's session, and I was just saying to Vas, actually we've got a good day to finish the week on in terms of as far as scheduled events go. And so just quickly recapping some of those things to look out for. Pretty quiet overall in the morning as far as Europe goes, and it really starts to heat up though in the US afternoon. You've got probably, I would say, the most important piece of economic data that's going to be coming out of the States this in the context of what's happened certainly this week from what Yellen has said. And that's because we get to find out what is the deal with US inflation. If we look at the charts most recently, if I go to the CPI print here, so this is US CPI year on year, and it was 1.9% last year. What's happened here is we've had a really persistent trend. Inflation basically from peaking in February at 2.7% has gone from 2.7, 2.4, 2.2, 1.9. If we look at the core reading, so let's just extrapolate out some of the volatile components, exactly the same trend has happened, and in fact it's getting all the more further away from kind of target, which of course is 2%. We've gone from 2.3 in January, and throughout this year inflation has just dropped again and again and again. Now the Fed have managed to talk this away for one-off reasons or transitory effects, as they would say, and that inflation ultimately, with the tightening of the labour force, will come back to trend higher towards their more comfortable area for them to go on and tighten policy going forward. The question mark is, though, if this pattern continues to move lower, well, let's have a look a bit more longer dated for US inflation. If we get down to 1.6, keep in mind we're at 1.7, so that's definitely within the realm of possibility. That would be the lowest inflation readings on a core basis in the US since really 2014. If we go below there to say 1.5%, we need to go even further back. We're talking about the lowest core inflation in the States since 2011. You would think then that we need to then start, given the fact that Yellen already communicated yesterday how she's not wholly confident about the future of inflation, that if we drop to 1.5%, that's definitely got to be troubling from a Fed point of view in communicating their strategy, where their predefined course at the moment is they're going to hike one more time. As far as most bank consensuses lie, that would be in December, and they're going to start this balance sheet tightening process commencing from September. Obviously September, December key meetings, because that's the updated summary of economic projections and also the press conference from Janet Yellen. So these numbers then, hopefully that puts in a bit of context about how important these numbers are, which are coming out tomorrow. Alongside this, and what makes it all the more interesting, is you've also got retail sales. So a good barometer then of the health of and the appetite of the US consumer. We had negative readings last time. We are expecting on a consensus estimate for a bit of a bounce back, going to 0.2% when it comes to US retail sales. Just in case my chart wasn't showing when I was going through those inflation readings from the US, this is what I was looking at here. This is core inflation. This is where we are at the moment. And again, 1.5% would put us all the way back down to here, 2011. It would be a real significant marker. Retail sales tends to be a fairly volatile data set. As you can see here, we've kind of flipped between negative and positive readings over the course of really the beginning of the year and the last 6 months. The previous number was, though, one of the biggest declines that we've had in some time. It did miss expectations. The decline was driven by lower sales of motor vehicles, electronics appliance stores, gasoline stations, and so on and so forth. So going back, let's have a look. It was the weakest reading you can see really since the beginning of 2016. And so these are definitely not signs that the Fed would want to see in their pursuit of being more hawkish. Certainly this is not going to help if this continues to weaken. This is only going to make them more and more uncertain about the future going forward. Just to cover things off, tomorrow you also get the preliminary reading of University of Michigan. Remember, the preliminary, i.e. the advanced reading, is always the one that's more market moving than the final one. This too has also softened of late. Now don't get me wrong, it's still tracking at actually a very high level as far as statistically this data set goes. If we look here, we're currently tracking around 95, which really is the highest that we've been all the way in recovery of the financial crisis, when we were down in the doldrums of kind of mid-50s. We're up near 100, so it still is very high, i.e. very positive conditions, but these are the soft data points that the market is looking at with some interest. Because what we've started to see, if I put it back on a column chart, is a slight deterioration from where we were at the beginning of the year. You can see here you've had the kind of Trump effect, everyone thinking this fiscal promise is going to really boost the US economy, massively stoked then consumer sentiment, as well as what we've seen from other more company-related readings like the PMI. But what we've started to see is soft indicators have started to just tail off slightly. And if we start to see things like retail sales coming in weak, and as we say, some of the weakest points since 2016, the beginning of that year, and we start getting soft economic data points weakening, again, all the more troubling it is for the Fed to execute then this more hawkish delivery. Just to round things off, if that wasn't busy enough for you, US earnings season starts tomorrow. JP Morgan, Citi, Wells Fargo. So these will set the scene for the banking sector. It's always the first, this is always the routine. You'll probably, JP Morgan will be first. Usually Citi and Wells Fargo follow, normally at 1 PM London time. And then people will use those results then as a pre-indicator of how the entire financial community will play out. This then leads us into next week when, as you can see here listed, we get a lot more companies coming through. Goldman's, Morgan Stanley, but then also other industries in focus. Healthcare, Johnson & Johnson, United Health, tech, IBM, Qualcomm, Microsoft, and then it really ramps up. So earnings season as well kicks off tomorrow. Looking at, finally on the calendar, Baker Hughes rig count. This for many years really was not a big deal for the market, but now it certainly has done for the oil traders, because the monitoring of how many rigs that the US is adding back online, if you like, is a decent precursor then of the output figures to follow. And certainly after seeing one of the first dips in the rig count 2 weeks ago than we've had in some 23 consecutive weeks, we've kind of reverted back to trend. Last week we added 7, US output has gone up 2 weeks on the trot now, 1% and 0.68% each respectively, which are pretty big increases from a percentage basis week to week for US output. So that number is also pretty interesting. Speaker-wise, Kaplan, soft hawk voter, speaking primarily on monetary policy. We haven't heard anything from Evans, who was due to speak earlier. Obviously, Janet Yellen appeared in front of the Senate Banking Committee today, but said absolutely nothing different from the House, completely as per the normal drill. It's just a repetition of her testimony to the different chamber of Congress. But Kaplan could be interesting just to see whether or not the Fed feel any need to, let's say, re-communicate their stance if they feel the market has misinterpreted what Yellen has said about how dovish she's been conveyed. So that's something to definitely keep an eye on too. That'll be at 2:30. So very busy day. Should be a good one for Friday. So get some rest. I know you guys have, in the live room, have executed some really good trades today. So well done. And then we're back on the briefing as per usual tomorrow morning. Okay guys, thank you very much. Have a good evening.